Well, good morning, everybody. We're a couple minutes early here, so we're just going to give everybody a few minutes more. So just warn you, we'll get started in about 2 minutes. It's very strange being in front of this computer, knowing that many people are looking at you, and I'm getting used to it, but barely. I'm determined to start on time today because we've had feedback in the surveys that we haven't left enough time for questions. So we want to do that today. We want to listen to what you tell us in the surveys, which reminds me to tell you that there will also be a survey at the end of today. And we truly value what you say. So if you can stick around for that, we'd really appreciate it. Well, good morning. Again, my name is Leslie Cliff. I'm a co-founder of Genus and chair of the board. And it's my pleasure to welcome you today to our annual seminar where we review the past year, 2021, and look forward to 2022. I'll be your MC today. I'll endeavor to keep us on track. A few housekeeping items. First of all, if you want to make your screen bigger, at the very top, there's a bar with 3 circles in it. And the second one is arrows going opposite directions. If you click on that, the screen will be bigger. So that's our first housekeeping. Second is if you have any questions at any point, please put them in the chat area and there will be a question and answer session at the end. So we're not going to handle questions during the session, but at the end. Also, if you have any technical problems, the first famous step is to reboot. So get out of the program, get back in, see if that fixes it. If it doesn't, then please type in your problem and hopefully somebody will get back to you to assist you. So let's get started. I want to begin by first acknowledging that some of us are working from the unceded territories of the Coast Salish, Tsleil-Waututh, Squamish, and Musqueam nations. We make this acknowledgement to reaffirm our commitment to improving relations between nations and our understanding of Indigenous cultures. So what is going to happen in the next 60 minutes? I will start with a review of 2021. I'll show how we rotated between the opening trade and the lockdown trade as COVID ebbed and flowed throughout the year. Then Justin Hahn, our strategist, is going to do a deep dive into inflation and what that means for your wealth, consumers, and government. Mike Thiessen, who leads our sustainable investing area, has an interesting presentation on how our legacy strategies are becoming less risky and as a byproduct, becoming more sustainable. Probably most of you know that Alpha Fix, a firm out of Montreal that we've worked with for over a year now, manages our bonds at Genus, about $250 million. And Simon Senegal is joining us today to share some of the insights from the bond portfolio, and also he will review the attributes of our newly launched global impact bond strategy. Finally, Wayne Michel, Genus co-founder, executive chair, he will share our outlook for 2022. We give him the hard stuff. COVID will stop being a market influencer. Obviously, it's here for the duration of mankind, but it will stop being a market influencer in 2022 is our view, and it will allow the economy to fully recover. So, a review of 2021. First of all, just big picture before we get into the stock selection. Interest rates rose in 2021, which means bond prices were down, which means holders of bonds lost money in 2021, about 2%, while stocks were up dramatically. Really a great year globally. Stocks were up about 20% around the world, except in China. And everybody who is a client at Genus has an investment policy statement. You have a targeted stock bond weighting, and everybody throughout the year was slightly overweight, whatever your equity weight policy was. And I think it's important to tell you that this isn't a consequence of somebody on the investment team waking up and having a view that the stocks should be overweighted, but rather it's a proprietary models that have been built over years that incorporate a vast array of data in a consistent and unemotional manner to generate signals that we follow on a monthly basis. So that is why we were overweight stocks in 2021, and it's actually why we're overweight stocks in 2022, but we'll let Wayne get into that. So now let's look at the slide that has it's got a fair amount of information on it. What it is, it's dividing the stock market into three groups. The easiest one to describe is technology. So those are technology stocks. And this chart is showing you every month of the year of 2021, what the Genus weight is in our balanced account, which would probably be the same as yours, what your active weight is versus the benchmark throughout the year. And so you can see that throughout the whole year, we've been underweight technology. There was a little ebb and flowing there, but interest rates rose in 2021. We think they'll continue to rise. And so high PE stocks, high growth stocks don't do well when interest rates are rising. Their valuations get stretched. And so that's why we're underweight technology stocks throughout the year. The more interesting story is the cyclicals, which I call the opening trade, and the defensive stocks, which I call the lockdown stocks. And if you look at the sectors, it makes sense that healthcare and consumer staples are in the lockdown section. And in the cyclicals, you've got industrials, financials, energies, things that do well when the economy is doing well. And so you can see we entered 2021 with the view, if you go back to this session a year ago, you'll see that we entered the view very optimistically and had an overweight in the open up trade, the cyclical trades, and had a positive exposure there and a negative exposure to the lockdown trades. In May, when COVID had the Delta variant come into play, and we went more defensive, we went more to the lockdown and brought back the opening trade. As the years progressed, we've come back really to neutral both places. You can see just at the end of the year, the blue line crosses over the gray line. So we now favor cyclicals over defensive. And again, Wayne will tell you more about that when he goes. So it was a good year in the market. What I want to do is get back to what we talk about, which is all the time we talk about consistent returns. That's really what is our ethos for our wealth clients. And we always show this chart. This is a balance account. So not all our clients are balanced, but probably 50% are. These are normal clients. They want everything. You want income, you want growth, you want safety. So this is back to June of 1989. When we started the firm, the blue line is the balanced account. And you can see it's not straight, but it's relatively straight compared to the components that make it up, which is the stock market and the bond market. More interestingly is the last period, say 9 years or so. On the next chart, we see what this looks like since 2013. And the reason we choose 2013 is because that was the year that we launched our fossil-free funds. And it's also 30 years is a long time to look at returns to feel like it's meaningful. But we can see here that what we say all along, and now we have more and more proof to say it harder and louder, is that the fossil-free funds do not give up performance. The performance is very similar to the legacy accounts. But it also is interesting to see in this last period that how poorly the bond market has performed with interest rates rising and how well the global markets have performed. And these returns for the Genus Balance Fund are all before fee. So that's a look at what happened in 2021, but 2021 is over. And as one of my favorite persons has always said to me, Leslie, you are only as good as your next success. So now we have to worry about 2022 and the challenges that it presents So, Justin, over to you. And how will inflation change the investment landscape?
Thanks, Leslie. Hi, everyone. My name is Justin Hanna, and I'm a macro strategist at Genus. I've been with Genus for about 4 years, working on the investment team, working on the economic side, as well as tactical asset allocation. Today, I will start by going over how we got to the high inflation economy we're in right now and what impacts it has on consumers, wealth, and governments. Then I'll finish off with what we expect for inflation going forward. 2021 still continued to be a strong year for monetary stimulus, and with it came a rebound in PMIs, Manufacturing Purchaser Manager Index, which is just a gauge for business activity and health. PMIs remained at an expansionary territory, and even with the lower money supply, it still points towards higher PMIs throughout the rest of this year. In addition, we saw continued fiscal policy support for the economies. So this chart shows the fiscal and monetary support stimulus as a percentage of GDP, fiscal support being through either direct checks or government spending, and monetary stimulus being money printing. You can see that the US, Europe, and Japan all remained above 50% in terms of their GDP expenditures, while China opted for more lockdown strategies to help combat the pandemic. All this money printing has helped the consumers, disposable incomes, and the middle class by putting more monies in their pockets. Disposable incomes, which is just after-tax incomes, rose sharply during each of the fiscal stimulus packages that were passed in the US. In comparison to the 2008 crisis, you can see how big it is. It was about $5 trillion in the last 2 years versus 2008, where it was just under $1 trillion. The direct stimulus has also provided a boost to retailers, with individuals being unable to travel and opting to spend money on goods rather than services. Retail sales collapsed during the peak of the pandemic due to the lockdowns, but came back sharply post-pandemic due to the policy support. We saw retail sales reach new highs and start a new trend line, and we expect this to continue with the supply chain constraints all being resolved later this year. The surge in stimulus, though, have come at a cost, and we've had an impact on inflation throughout last year. We can see that the consumer price indexes and the producer price indexes all reached new highs at about 7% and 9% for the year. This was initially thought to be transitory due to the low base effects and other temporary measures, but as the year went on, it was clear that inflation was going to linger longer than expected. Inflation is a monetary problem, so as we printed more money, we expected higher inflations given the sheer size of the monetary support. And as PPIs rise, we also expect consumers to still absorb some of those costs. This has also had an impact on real wages for the middle class. We can see here that real wages dropped significantly into the negative territories due to this high inflation. So despite nominal wages increasing for the year, due to the shortage of workers and the higher nominal wage growth, we can see that it still remains in the negative territories. This lack of wage growth is also shown in the consumer sentiment indexes. So consumer sentiment collapsed during the pandemic as expected, but it was recovering until early last year. But then the Delta variant hit, as well as more lockdown measures and higher inflation numbers, and it still remains in the historical low areas in the last 5 years. So this is despite all the things looking up and the market looking past the Omicron variant. The monetary stimulus has also helped increase asset values and wealth generation on that side. Individuals who owned inflation hedges, such as financial instruments and real estate, such as yourselves, saw a surge in wealth during the past 2 years. You can see that the money supply line and the household wealth line are fairly correlated during the last 2 years, despite it being quite volatile during the periods before that. This is what we call asset inflation and the wealth effect. In addition to the impacts on individuals, inflation has worked in favor of the governments and their massive stimulus packages. Government debt to GDP levels in Canada, and more extremely in the US, have shrunk significantly due to the higher inflation, helping boost up GDP numbers in the US. Canada has also benefited, but the amount of stimulus was significantly lower in Canada than the US, and Japan's economy still remains stagnant, so their levels are relatively higher. This is a bit more clear in the next chart as well. We can see the two lines here, the orange line being US nominal GDP and the blue line being US debt. And you can see that the orange line is much sharper and steeper than the blue line, which means that the debt is outpacing the growth, which means the growth of GDP is outpacing the growth of the debt. The strong demand in the economy, along with the economic supply chain issues, have caused shortages throughout the economy. These are just some of the shortages that we're seeing across the world and the economies. So the top left showing the US housing inventory to sales ratio. So housing still continued to boom in the economy due to historically low rates as supply failed to keep up with the demand. We also saw motor vehicle parts as well as retail sale inventories shrink, with retail sales inventories being at the lowest in the last 30 years. And in addition, we saw job vacancies still increase and remain elevated as workers who left during the peak of the pandemic failed to rejoin the workforce. Inflation is, in short, just too much money buying too little goods. And from these charts, you can really see that effect here. All these shortages continue to have an impact on inflation, and we do expect this trend to continue throughout the year. The US break-even bond yield still points to higher risks in the shorter term, with the US 5-year being at about 2.8%, higher than the 10-year at about 2.4%. Due to the higher inflation rates, central banks will have to tighten this year and raise interest rates, but those interest rate rises won't affect the shortages that I talked about during the last slide. So we still expect inflation issues to linger in the shorter term and stabilize in 2023 and 2024. Next, I'll pass it off to Mike, who will discuss the sustainability and carbon risk of our portfolios.
Thanks, Justin. Hi, everyone. So I'm the Chief Sustainability Officer and a partner at Genus. So I lead the sustainable funds and portfolios, also the impact research and initiatives that we do as well. So at Genus, we have a deep focus on our asset mix, stock selection, and also sustainability. So I'm going to be talking about how well our funds did in terms of sustainability today. And then I'm going to be talking about lowering carbon risk and what that means for some of our portfolios. So first of all, sustainability for the funds. So we'll first look at fossil fuel reserves. So as you can see, our fossil-free funds have no fossil fuel reserves, as you would expect. And then we have CanGlobe equity and dividend equity. Both of these funds don't have any constraints right now when it comes to fossil fuel reserves. So it really depends on what we're investing in at the time. And that will really determine whether they have high reserves or not relative to the benchmark. Then we have carbon intensity. So carbon intensity is tons of carbon emissions per million in sales. So if a company is emitting 50 tons of carbon emissions for every 1 million in sales that they have, then their carbon intensity would be 50. And so in our fossil-free funds, we put a lot of effort into making sure that the carbon intensity is quite low for these funds. So we actually have thresholds that we can't go beyond for individual stocks, and the overall portfolio we want to keep quite low. For CanGlobe equity and dividend equity, we don't have constraints on carbon intensity there, but they tend to be around the benchmark. Right now, they're a little bit below their benchmark. And then for ESG ratings, this is environmental, social, and governance ratings. You can see that our fossil-free funds score quite high when it comes to ESG ratings. These are third-party ratings that are given to us. Our high impact equity fund is really the star when it comes to ESG ratings. And there we're trying to buy the best of the best, most impactful companies. So it makes sense that that's quite high. And then the CanGlobe equity and dividend equity are typically around the benchmark when it comes to ESG ratings. Right now, the CanGlobe equity is slightly higher, which is great. And now onto impact. So over the past couple of years, we've been using a net impact score to gauge impact. And the way that we come up with a net impact score is we look at a company's revenue and we look at what percentage of that revenue is coming from positive impact activities. So positive impact activities could be a business line that's in healthcare or education or renewable energy, energy efficiency. Then we also look at revenue coming from negative impact activities. So these could be activities such as tobacco or gambling or highly carbon intensive industries. So for our fossil-free funds, these funds have between 8 and 9% positive impact. It kind of varies, but it's usually around these numbers. zero negative impact. We make sure that we don't have any negative impact in these funds. That's a restriction. And then the net impact is the same as the positive impact, because net impact is positive impact minus the negative impact gives you net impact. And then if you look at our CanGlobe equity and dividend equity, they also have positive impact. So they do have some, healthcare, possibly renewables in some of these funds at times. And then they do have some negative impact. Right now, they do have some more carbon intensive industries in these funds. So they do have more negative impact. And then their net impact is negative for these funds right now, but that does vary. And then if you look at the benchmark on the far right, the net impact is about flat. And then here's our fossil-free high impact equity fund. This fund really tries to maximize the amount of impact while also meeting financial goals. So in this fund, we have some companies in this fund that will have 100% positive impact revenue. So that could be a renewable energy company. We have a lot of healthcare companies that are in the high 90s for positive impact revenue. But on average, we want the companies to be 50 or higher. So right now, on average in the portfolio, it's 52.5%. So that's great. Zero negative impact. So net impact is also 52.5. And that's much higher than its benchmark MSCI World that has net impact of 3.6. So now we'll move on to carbon risk. So carbon risk is one of the biggest risks that investors are facing right now. Many investors know about this. Others don't know that they're facing this risk in their portfolio, but they are. So right now, governments have made pledges, as probably many of you have heard, that they want to go net zero by 2050, some of them slightly before that, some of them slightly after that. But in order to get there, these governments are going to have to massively transform their economies, their infrastructure in order to get there. On top of that, many companies have made pledges that they want to be net zero, some of them by 2030, some of them by 2040. And so those companies are going to have to change. And then also the companies that are within their supply chains are going to have to change if they want to keep supplying products to those companies. So as a result of this, any company that is highly carbon intensive is going to have to adapt a lot in the next couple of decades, or else the demand for their products are going to really plummet. So within carbon risk, some of the individual risks that companies that are carbon intensive are going to face. One of them is increasing carbon taxes. So that's one of the ways that governments are going to continually try and lower the overall carbon emissions within their country. Of course, we have carbon taxes in Canada. These are expected to rise over the years. There's carbon taxes around the world as well. Another method for governments is going to be more regulation on carbon intensive industries. And that's going to be quite costly for these industries as well. Potential litigation. There's already been lawsuits against many energy companies, carbon intensive companies around the world. Many of these lawsuits have been issued by governments themselves. So that's going to be an issue, a big risk for carbon intensive companies in the future. And then probably the biggest one is just cultural and consumer backlash. So many of these companies and countries that are deciding to go carbon neutral are doing it because they know that their consumers or their voters or their citizens are wanting this, and the future generations are wanting this. And so we already see a lot of consumers that are wanting to buy products from companies that align with their values. So it might be products that are coming from companies that are maybe B Corps, or maybe companies that have lower emissions, or companies that help them have lower emissions as an individual. So that's a big risk in demand for these high carbon intensive companies as well. So we've actually done a lot of tests in our models, the models that we use for our conventional funds, to see whether lowering carbon risk exposure in these models would impact the strategy at all. And we found that if we lower carbon exposure, it actually has increased performance, lowered volatility, and then remain the same for max drawdowns within these portfolios if we were to test this on historical data. So because of these very positive results, even though it doesn't necessarily mean that it's going to be beneficial in the future, but we are very happy with these results. Because of these results and because of these carbon risks that we see coming up in the future, we think that it's quite a sound strategy to lower carbon risks, even in conventional portfolios, if we want to lower risks and increase our risk-adjusted returns. So within 2022, one of the projects that we're working on within the portfolios is to lower the carbon risk exposure within these portfolios. So it's something that we think will improve the strategies plus help the planet at the same time. So something that we're excited about. So continuing on with the sustainability theme, we are going to have AlphaFix talk very shortly here about our global impact bond fund that we partnered with them on. So AlphaFix right now manages about $250 million in fixed income for Genus and Genus clients. They manage our strategic bond fund, government bond fund, short-term bond fund, fossil-free bond funds. So they do a lot for us right now. And then last year we challenged them to create a global impact bond fund because they already are experts when it comes to green bonds. And we knew that our clients wanted more global exposure when it came to fixed income. They wanted more US dollar exposure, but they also wanted to make impact with their fixed income instruments. So AlphaFix really rose to the challenge and was able to create this fund for us. So Simone will tell us more about the fund.
All right, thank you, Mike, for the introduction. So hello, everyone. I'm Simon Senecal. I'm pretty happy to be here with you today, directly from Montreal, where it is very cold today. So my role at AlphaFix Capital is to oversee all of the responsible investment activities. So that includes ESG integration, carbon footprint calculation, identifying sustainable bonds, and calculating their impact. So as Mike mentioned, I will focus today on the Global Impact Bond Fund. So the main difference with this fund compared to other mandates that we manage for Genus is that it is benched against the US aggregate index. So that means that we have more exposure to US issuers. The main objectives of this fund is to participate in the low carbon economy and to contribute to the United Nations Sustainable Development Goals. We see at the bottom here that we have a duration in the portfolio that is lower than the one of the index, which means that we have lower sensitivity to movement of interest rates. Now, we've identified that to go towards a low carbon economy, the biggest opportunity is to participate in the transition towards renewables. We've seen lately that the International Energy Agency has quantified what needs to be done to meet that challenge. And to start with, on the left side, we see that in terms of solar and wind, we need to increase the capacity by 4 times between now and 2030. So that's a lot, that's a lot to be done in less than 10 years. And in terms of investments, we see on the right side that if we take only 2030, for 1 year, we need to invest more than 1.5 trillion US dollar to meet that objective. So that is a lot of money. Now, taking into account the context of the Global Impact Fund, I will focus on 2 specific examples here of how we can contribute with the fund to meet that challenge. We have here the first example, which is Verizon Communications that issued a $1 billion US dollar green bond. And with the proceeds, they will purchase electricity from solar and wind projects. These projects alone on a yearly basis have the impact of the equivalent of taking off the road 200,000 cars a year. So, I mean, that's a tangible impact. And we see at the bottom each of the projects that Verizon will contribute to and their source of electricity production. So they're all located in the US. Now, as a second example, we have CDP Financial, which is one of the largest institutional investor in North America. They also issued a $1 billion green bond. And this green bond program is part of their commitment to reach a net zero portfolio by 2050. With the proceeds of their green bond, they will partner with Invenergy Renewable, which is the largest independent renewable energy company in North America. Just to give you an idea of the size of their portfolio, they produce 15,000 megawatt of electricity coming from wind and solar in a year alone. And to give you a relative idea of how big that is, it is 25% more than what comes out of BC Hydro. So yeah, that's a lot of electricity. Now that we're done with the two specific examples, let's take a step back and look at the portfolio in a whole. So if we start on the left with the allocation per project type, we see that the green part is what we just discussed, renewable energy. So at close to 30%, it is the most important project type category in the portfolio. It is followed by low carbon buildings, public transportation, and by the way, these two categories also need renewable energy to meet their own low carbon targets. So there's a domino effect in there. If we go to the right, we see the allocation per bond type. And leading, we have green bonds at 70% in the portfolio, social bonds at 4%, sustainability bonds at close to 25%. And I would like to mention that sustainability bonds are impact bonds that allow issuers to finance both environmental and social impact projects. These proportions are pretty determined by the size of each of their market as well. So let's say green bond market is the biggest. Social bond market will grow in the coming years and will probably increase the proportion in the portfolio as well. And to finish, we see at the bottom that we have the contribution here to the from the portfolio to the Sustainable Development Goals of the United Nations. So we see that we can contribute to 13 out of the 17 SDGs, and we have the four most important contributions at the bottom, which are number 7, clean and affordable energy, number 9, innovation and infrastructure, number 11, sustainable cities, and the most important one, fight to climate action, number 13. So I am done for today. I will see you at the Q&A section, and I will leave the floor to Wayne.
Good morning. I'm Wayne Michel, Executive Chairperson and Chief Investment Officer at Genus and one of the founders. Good to be here. Well, 2022 is going to be an interesting year. We believe the advent of the Omicron variant will help transition us into stronger growth and result in, at the end of the day, the pandemic becoming an endemic. So we're optimistic on 2022 and 2023. We believe this will help support the service sector, which has been really battered in the economy over the past couple of years. Now, central banks have signaled they're about to raise interest rates, and a lot of the short end of the short bonds, the short end of the yield curve, has discounted a lot of these impending rate hikes. We still think there's more room to go in terms of rates going higher. So our view is for a strong economy and higher interest rates. And here's how we are positioned. Right now, we're favoring stocks over bonds. And within bonds, we're favoring corporate bonds over government bonds. Now, within the stocks themselves, we're favoring cyclical or economic sensitive stocks over defensive stocks and value stocks over growth stocks. Growth stocks were the big winners during the pandemic. And with the economy improving, we anticipate the value will do better. And that includes dividend stocks, which are value stocks. And regionally, we still favor the US over the rest of the world. There could be a tactical play in Europe if the economy really gets growing globally, but right now we still prefer the US. Let's look at some of the issues behind this. If you look at the short bonds have already discounted Bank of Canada tightening. This is mistitled, but looking at interest rates around the world, they are still low. In fact, they're negative in Germany. In Europe right now. So we think there's more upside here over the long term, in spite of, and European and global real rates are still negative at this point in time. So we think there's more upside coming down the road. And the Fed and central banks around the world are still printing money as we speak. If you look at the Canadian yield curve, this is showing yields from 3-month up to 30 years. There's been a dramatic shift in the past year. The short end in particular has gone, this is called the belly of the curve, has jumped up dramatically, where the 5-year bond is now yielding 1.5%, a big increase, and discounting, I think, a lot of the hikes that we're anticipating with the Bank of Canada. So that's one good thing, I think, is that I think the longer end of the curve is more at risk here, the 10-year, 30-year. In fact, the central bank, the Fed, for example, is talking about doing a twist operation where they want to push the longer rates up more so than the shorter term rates. Now, industrial metals are forecasting higher 10-year yields. If you look at the relationship between the 10-year yield in the US and the ratio of industrial metals to precious metals, it's a pretty good relationship, and it's forecasting a gap right now is forecasting 10-year yields to go higher. And just recently, the US 10-year bond broke out of its pandemic trading range into higher levels. And it's in a new range now where the high could be possibly as high as 3%. I don't think it's going to go there this year, but it's probably going to have a 2% handle, somewhere between 2 and 2.5% we anticipate in the coming year. Now, looking at the classic, this is the classic yield curve, and it's the ratio of T-bills to 30-year bonds. And it's been a pretty good forecaster of recessions. The shaded areas are recessions over the past 40 years. And whenever the T-bills are yield more than the 30-year bond, you end up with a recession in a couple of years. And you can see that it happened in 2001, happened in 2008. We had a near inversion of the classic yield curve in 2019. The Fed made a mistake. They tightened too far, too fast, given the weakness in the economy. But we end up getting a recession, of course, caused by the pandemic in 2020, in and out. And right now, we're nowhere near an inverted yield curve. In fact, the central banks are still printing money as we speak. Now, let me remind you, so there's a lot of fear out there. We're going to get a recession. The Fed's going to we're going to get a recession. It's the end of the world. Let me remind you what the Fed's mandate is. The Fed's mandate is to maintain orderly economic growth and price stability. And right now they're focused on price stability. And however, the Fed chair, Powell, said they will raise rates in a slow, methodical manner while watching the impact on economic growth. So they have this dual mandate. They want to impact price. They believe that prices will come down in 2022, at the end of 2022 and 2023. And so they want to bring them down. And as Justin showed, a lot of the problems right now are there's shortages. And so I'm not really sure how much they can impact in the first place, but they're going to tighten things up and do it in a methodical, slow manner. Now, looking at stocks, they're relatively fair. They're fairly valued relative to 5-year bonds. They've discounted. They've had great earnings growth. What we look at here is we look at earnings to price, earnings divided by price relative to 5-year bonds. And right now, you can see the U.S. market's more expensive. There's more growth in that market in the first place, anyways. And Europe is the cheapest versus Canada and the U.S. So the market's okay in terms of valuation. There's big discrepancies within the market, and I'm going to talk about those. And so in the kind of environment where we have stronger economic growth, rising inflation still, we think it's, and our models say the same thing, be overweight stocks versus bonds. Now, within the market, you can see that U.S. corporations' earnings continue to outperform the rest of the world. And we've been saying the same story for a long time. And there's just more innovation. There's more technology there. They have an unparalleled track record of success. And so we're still favoring the U.S. We think there could, as I mentioned earlier, could be a tactical trade into EFA if the global economy really gets rolling, but only a tactical one. So we're overweight the U.S. and we're market weight in Canada. Canada could go higher, I think, if we with a global recovery, as financials and energy do well. That's Canada effectively. So we're still in the U.S. and watching the numbers as they come out. Now, looking at value versus growth, value stocks in particular. Value stocks right now are cheap. So value, what we mean by value, we mean low price to earnings, low price to book. And what we've done here with this chart reflects, we go into the market, we look at the market, we look at the bottom 20% of the market in terms of cheapness, the most cheap stocks, and then we price them based on PE. And on a PE basis, they typically trade around, on average over the past 20 years, but they have a lower PE of around 5 versus the rest of the market. Well, today that gap is not 5, it's 9. So they are cheap versus the rest of the market. And there's parts of the market that are very expensive, and the tech, some tech areas are expensive right now. So right now the current market PE, forward PE is around 23. So minus 9, that's about a 14 PE for value stocks at this point in time. So they're not bad value. Now, stocks can be cheap, but they often need a catalyst to do well. And we think there's one coming around right now, and that's higher interest rates. If you look at the relationship between corporate yields and value stocks, value versus growth in particular, it's a pretty good relationship. And it makes sense too, as rates come down, as rates come down close to zero, for example, what does value really mean? The discount rate is so low, it's hard to put value on things. So as rates go up, all of a sudden the discounting mechanism makes sense. And so we anticipate that as rates start to rise, or corporate rates start to rise here, we'll see value continue to underperform growth. And value has underperformed for a long, long time. And so we anticipate it could have some upside here. If you look at dividend stocks, well, dividend stocks, number one, are value stocks. They have to have the cash flow to pay for the dividends, obviously. They are cheap. Looking at our metrics, they're still cheap. They were very cheap during the pandemic as people piled into growth stocks and the big technology winners. So dividend stocks have done well, but they still are cheap versus the rest of the market. So we're overweight there. One of the places that concerns us is China. They changed with common prosperity, they changed their capitalist rules, if you will. And who knows what's going to happen next there? They could change, hit any sector at any point in time. They've gone through the real estate sector, the education sector, and so that's causing problems. Also, the real estate side of things is very leveraged. In fact, it's reminiscent of 2007, 2008 in North America. Evergrande, which is we've all heard about, is one of the worst performers. These are the bottom 20 stocks in the Chinese market last year, and Evergrande is at the head of the class. And just recently, the Chinese government made them blow up 39 faulty buildings. Imagine if you're a bondholder and you're seeing the company you have bonds in blowing up the assets right in front of you. So that they have a problem in the real estate market. It reminds me of 2007, 2008. And I'll remind you in 2007, 2008. In 2007, we saw cracks in the real estate market. It wasn't, and after that happened, the central banks, the Fed eased very much, dramatically. And we still had the Lehman problem in 2008. So they have problems in the real estate sector, in the credit sector. They're not going to be easy to overcome. And you're hearing a lot of comments from other investors saying it's time to, Chinese stocks have been repriced, time to step back in. I think I'd wait and see how the dust settles here before we jump back into this. This could have implications on Vancouver real estate, as Chinese have come over and bought homes in Vancouver, have to take that money back to solve some of their problems back home. We'll have to wait and see. Now, as I mentioned, in 2007, the Fed eased dramatically. Historically, the Chinese have much faster money growth because they've had faster growth, and their economy going back 20 years. But during the pandemic, they've had slower money growth than the rest of the world. We anticipate that they're turning this spigot on right now. They've signaled that and done a few things over the past month or so, and they're going to start opening up the money supply there, I think, to try and mitigate some of the issues they have going on. So that'll be interesting to see where it goes. What happened in 2007, 2008, as you recall, is the central banks here eased, and because of the concerns in the economy, the money didn't go back into the U.S. economy. It went over to Asia, to China. We might get the reverse effect this time around here. We'll see how it plays out. So looking at our portfolios, these are the active weights of our CanGlobe. CanGlobe is our flagship benchmark growth-driven strategy, and these are our largest active weights in our CanGlobe strategy. Active weights mean it's the weight in the portfolio relative to the benchmark. And our benchmark that we're using in CanGlobe and our fossil-free CanGlobe is 25% Canada, 75% the world. So right now, our biggest active weights in terms of weights above the benchmark, as you can see, are Toronto Dominion Bank, Bank of Montreal, Pfizer, etc. And most of those big active weights have great rankings based on our models. They're all A ranked, A being high. Most of them are A high, and F is low. And the smaller, the negative active weights are at the other end. You see Tesla at the bottom, Brookfield, Meta, Shopify, etc. There. So those are active weights, and most of our biggest active weights right now, given our view, tend to be more value oriented and cash flow oriented. So and cyclical as well. Now looking at the fossil-free CanGlobe, it's got the same benchmark as I mentioned as the CanGlobe. It's 25 Canada, 75 the world. The main difference here is that you won't see any energy holdings, obviously, and they all have higher ESG scores. And you'll see a lot of negative active weights, and the big FANG names: Apple, Alphabet, Amazon, Meta, and Microsoft, even though some of them have good rates. And they do have problems from an ESG perspective. Some of them have anti-competitive behavior, labor issues, and also tax avoidance, amongst other things. So that's the big difference between that fund and our CanGlobe fund. Looking at our balanced fund, where we sit today, as of December 31st, we're 70% in equity, 27.8% in fixed income, and 2% in cash. As you can see, during the course of this year, we raised equities from 66% to 70%. But beneath that, we made a big shift into our dividend strategy. Our dividend strategy went up 10 points from 23.5% to 33% during that period. And that reflects our view on value and the economic recovery, and also the outperformance of the growth stocks and technology stocks, for example. So also you can see that we have our beta adjusted or risk adjusted equity. It was 61.1 at December 31st, only 2 points higher at 62.2 in spite of more equities, because we made that shift to the lower volatility, cash flow driven dividend strategy through the course of the year. So in summary, in our balanced fund, we're favoring stocks over bonds, and within bonds, we're favoring corporate bonds. You can see we only have about 5% in federal bonds right now. Within stocks, we're favoring cyclical stocks over defensive stocks, and also value stocks over growth stocks. And dividend strategy is a value strategy. And regionally, we're favoring the USA over the rest of the world right now. And so we're overweight financials, materials, energies, and some consumer discretionary stocks. We believe that we are well positioned for 2022, and just thank you for joining us today. And over to question period.
So I'm just going to ask everybody to come back in case there's a question for you, which I think there will be. Well, I might get it started. Somebody asked, do we anticipate any income tax changes going forward? And, you know, really we don't have any expertise there. We follow newspaper the same as everybody else. And we do wonder how the debt's all going to get paid. And we do tell people that we don't think taxes are coming down in any way, but we really don't have a crystal ball on what income taxes are going to do. Simon, somebody asked, there's lots of great questions, and this one intrigues me, so I get to choose. And it's, how do you decide that something really is a green bond when we all know there is so much greenwashing out there, that are people calling themselves green that are nowhere near green? And what kind of guardrails does Alpha Fix have in place? And Mike, it might even be the same question for you at Genus. How do we be sure we're not being tricked by green wrapping?
Yeah, so thank you for this question. It's actually pretty simple. There are guidelines out there. We look at the green bond principles that are worldwide, or globally recognized. So they tell issuers how to issue green bonds in terms of the use of proceeds, how they evaluate projects and choose their projects. Also, they tell what they need to report on for the impact and where the funds are going. But in terms of use of proceeds, they don't go far enough. According to the green bond principles, an issuer could finance energy efficiency for an industrial process that uses fossil fuel. So there's been controversies in the past on that front. And to avoid that, we look at the use of proceeds as defined by the Climate Bonds Initiative's taxonomy. The taxonomy is simply a list of eligible project categories, and how the CBI defines their project categories that are eligible is by saying, like, what will be part of tomorrow's economy, and meaning that we need renewables, we need to phase out of fossil fuel. So it's a much stricter list of eligible project. So combining the green bond principles and the CBI's taxonomy, we think we follow best practices.
Great. Well, thank you, Simon. Mike, I'm going to next one to you. So somebody asked, what the Canadian banks, what's the carbon risk to Canadian banks? And there's rumors of reserves having to be set up to finance the situation. What do you see?
Yeah, I think that's a really good question. So the carbon risk for banks is basically in their lending book, because especially for Canadian banks, they are lending to oil and gas companies. And so if you are lending on a longer term loan, and that industry is facing increased regulations, increased carbon taxes, consumer backlash, then you're at risk of not receiving that money back, especially if it's something more long term. So that's the risk of a lender when it comes to carbon risk. And so the way that we deal with that at Genus, because we do invest in Canadian banks, we do invest in international banks, is we are more strict with banks than with other companies when it comes to carbon related or environmentally related controversies. So we don't want them to be funding anything that's highly controversial or extremely carbon intense. So first of all, taking out the kind of the worst of the worst types of lending. And then beyond that, we're continually engaging the banks. So we use an organization called SHARE. They're a great organization that engages companies and encourages them to improve their practices. So with banks, we're trying to get them to be more transparent about their lending, so then we can actually know the exact carbon risk that they have. And then we want them to lower their exposure to oil and gas so that they're not overexposed to carbon risk. And we're wanting them to increase their lending to clean tech, because clean tech will really hedge against this issue, because as we transition to a low carbon economy, the clean tech companies are likely to do quite well.
Okay, good answer. Wayne, I got two for you, a quick one, and then probably they could both be quick actually. What is a dividend stock, first off? And then how does U.S. politics influence your investing?
What a dividend stock is simply a stock that has a yield, and we focus on stocks that have that pay out dividends. And we focus on the chart I put up there was dividend stocks that was the top 20% of stocks in the market that had a high yield. So it was the highest yielding 20% stocks in the market. Within our strategy, within our dividend strategy, we're focusing on dividends, a dividend rate between 3.5 and 3.75%, and also a lower beta in terms of 0.75 to 0.85. So higher dividends, lower volatility. And I guess it does impact our view on the economy in terms of it's really a function of government spending here, and monetary policy is important, but government spending is important as well. And I think that's had a big impact on where we sit with inflation, where we sit right now, for example. I think the last $1.9 trillion out of the U.S. was too much. It was really putting gasoline on a dumpster fire in terms of, and I think Justin's charts showed it explicitly, how the money printing, the government spending and the money printing really boosted disposable incomes and helped cause this supply-demand imbalance. And inflation simply is too much money chasing too few goods. And we've had that, way too much money, too much government spending, and too few goods. And that's how we ended up where we are today. So they simply spent too much money, I think, and they should have went slower and just edged into it. And they didn't. So it matters, the fiscal agenda of governments do matter, especially when a lot of them, like the US right now, have a lot of debt to GDP. And it'll be interesting over the coming years how we get out of this fix.
So that really is a great introduction to a question, which is, so Genus, we are driven by models that are very unemotional. They're rich in data and tested over years, and they give us signals and we invest according to those signals. We call that the science of managing money. But as you just heard from Wayne, there's also judgment involved. And so Wayne, how do we thread the needle? How do we use science and art to come up with our strategies?
Well, number one, we have a great platform of models in terms of stock models, macro models. That's the basis of everything we do. Then within that, we're on what's going on in the world every single day. We have morning meetings every day. We look at technicals. We look at sector rotation. We have some sector rotation models. So we're keeping our ears to the ground every single day. And especially now with what's going on with the pandemic, we're more responsive. And I'd say we're more responsive to what's going on in the market, given the volatility, than we've been any time in the past. And I think the pandemic did change how we do things and forced us to be more day-to-day, month-to-month, predicated on how things are changing in the world. But we have that backdrop holding us up. It's really a great foundation. For example, our portfolios, we showed you the Can Globe and Fossil Free, they have our highest ranked stocks in them. So within that, so today managing money, you have to be able to pick the right stocks, but able to deal with the style cycles and the sector rotation. And I think we've gotten better at doing those things.
Great. So thank you, Wayne. Justin, just talking about the supply chain, kind of two questions in one. Is there a leading indicator that can tell us whether the supply chain is getting better or worse? And do you think the supply chain will have an impact on growth stocks?
Yeah, so to answer the first question, some of the leading indicators that we've been seeing are coming out of shipping ports, and they're all turning very positive. There was a huge backlog heading into the holiday season, but that's been cleared up partly and is clearing up, and there are more positive signs of it clearing up. So we're very hopeful for that. And to answer your second question about hitting growth stocks, not too much. We haven't seen too much evidence of it hitting those growth stocks last year, but we may see a bit here. A lot of the car companies and semiconductor companies have been hit due to the supply shortages, but in return, they have raised prices and are still selling out It's hard to find a computer nowadays. It's hard to find a car nowadays, and their margins are just still stable there. So not too much of an impact. And as things clear up, we hope that they continue to do a bit better in this more technology-focused area that we're in now.
Thank you. We're getting near to the end of our questions, but I guess, Wayne, this is probably to you. What do you think the impact on Canadian stocks and bonds will be as a result of what's happening in China?
Well, generally in China will have lower growth, I think, because of what's going on there with their credit problems. That could have an impact on global growth. Canada's tied to global growth, obviously, in terms of our metals and things, and also the U.S. But I think it's, if China slows down, it might mitigate some of the inflation issues that we're facing worldwide. So I don't think China's going to impact Canada that much. If given our view of the world's stronger economic growth globally, China might just mitigate some of the inflationary pressures. So if China really had a negative impact on the global economy, then that would affect Canada definitely.
Great. And I'm just seeing a few more. This is stimulating more questions. So Wayne, what is our view on cryptocurrency?
Well, cryptocurrency, I think it's here to stay. There's all kinds of issues around us investing in that because of security regulations that we have to deal with that have to be ironed out. It's here to stay, apparently. It's a lot of the dizzy heights it achieved, I think, have been driven by the liquidity. Liquidity is drying up right now. It's tightening up. It's going to tighten up even more. I think that'll have a negative impact on crypto. We've seen a lot of the concept stocks, or say concept finance stocks, have really gotten thumped. I know Kathy's Wood's ARC is off 50%, from its highs. So I think, the old saying, when the tide goes out, it exposes a lot of different people. So I think it's going to have a tougher go, I think, with tighter liquidity. But I think it's here to stay, and it's getting institutional acceptance. But
But I guess the question, Wayne, is when might Genus invest in them? We're not investing in them now. What would change our view?
I would say some sort of security law around crypto, in terms of, and that's coming. They're looking at it right now. The SEC is looking at it. The U.S. government's looking into it. I would say we're going to wait for that. And it's also, we have to contend with that from our own security commissions as well. So we have to wait for more regulations, I would say.
So I'm warming up to do the last question here, and it's really a combination of many. Your comment about troubles in China affecting Vancouver real estate has stimulated a lot of interest, Wayne. So a little more color maybe on what you see, or read the Canadian Vancouver real estate market, given what's going on in China.
Well, number one, as rates go up, it's going to have an impact on probably on real estate, regardless of China. But a lot of money came here when China was doing well, and when they're not doing well, they're going to repatriate some of that money back to China. And I think you could have people that are getting impacted right now in China, liquidating assets here and bringing that money back to China. So that's my concern, if we see more of that in the coming years. And common prosperity has hit a lot of sectors just like a whack-a-mole. They were doing well, all of a sudden, bang, they get taken down. Education stocks were down like 90%. What's the next sector to get hit there? So there's a lot of, the rules are changing so dramatically there. I think if you're an entrepreneur in China, you must have some concerns about your business model and how it can work going forward. So I think if things tighten up there and with slower growth, money could leave Vancouver and go back to China.
Great. Well, thank you, panel. Thank you, participants. Most importantly, thank you, audience, sharing your time with us. We really appreciate it. Just quickly, I just want to give a quick heads up for our next webinar, which will feature Retiring with Purpose. And you can click on the link right there if you wish to register. And then last but not least is our survey. So if you could stay on board for that. And again, before we leave, I just want to say thank you for your time. The whole firm gets into this, guys. It takes a lot of man hours to prepare this. And it's a really bonding experience. It's like putting on a show or something. So it's great because it helps cement our views and gives us material to talk to the marketplace with. So thank you for putting us through this. We hope you enjoyed it. And please participate in the survey. And we'll see you at some point. Thank you very much.